A significant change is underway across financial markets. Big Northern European investors are quietly reassessing their strategies. They are looking closely at how much money they hold in US assets. For years, US bonds and stocks were seen as the safest place to park capital. This long-held assumption is now being questioned. The shift is not driven by typical market cycles or economic forecasts alone. Instead, it is a direct response to rising geopolitical tensions and unpredictable policy announcements. This represents a fundamental reevaluation of risk in a world that feels less stable than before. This is not a small matter of portfolio adjustment. European countries collectively own an enormous amount of US assets. The total value is approximately $8 trillion in bonds and equities. This figure is staggering. It is nearly double the holdings of the rest of the world combined. Such a large concentration gives European investors significant influence. When they decide to move their money, the effects can ripple across global financial markets. The first major effect is the direct action of investors. Pension funds are on the front lines of this shift. Charged with safeguarding retirement savings, they are naturally cautious. The recent rise in global political risk has made them rethink heavy reliance on dollar-denominated assets. A clear trend has emerged. These funds are actively selling some of their US holdings. They are bringing that capital back home to Europe. This is already happening. Danish pension funds led this move last year, seeking to reduce vulnerability to sudden US policy shifts. The second key fact involves the financial system itself. The ECB and the European Systemic Risk Board are paying close attention. They have issued warnings about potential dangers. Their joint reports say geopolitical shocks often lead to tighter financial conditions. Credit can become more expensive and harder to get for businesses and households. Market stress can increase and banks might face difficulties with foreign currency funding. These risks are now a top priority for regulators across the Eurozone. The line between politics and finance has become increasingly blurred. In the past, investors often focused primarily on economic data. They looked at inflation, interest rates, corporate earnings. Today, they must also act as political analysts. A single tweet, a surprise tariff announcement, a shift in foreign policy can move markets more than a month's worth of economic reports. This new reality forces a change in behavior. Capital flows are no longer just a reflection of economic opportunity. They are also a measure of political confidence and a reaction to perceived threats. This connection is now an explicit part of policy discussions. When faced with trade disputes, the conversation is not just about counter-tariffs. It now includes financial measures. France, for example, has urged the European Union to use its anti-coercion instrument. This tool can target foreign investment and finance, not just trade in goods. In summary, the ground beneath Europe's financial landscape is shifting. This is not a distant or abstract trend. Money is already moving. Large, influential investors are actively reducing their exposure to US assets in response to a riskier world. This is a deliberate and calculated response to the fusion of politics and finance. The decisions being made today in the boardrooms of pension funds and the halls of governments will have lasting consequences. They will directly affect the availability of credit, the competitiveness of industries, the security of jobs across the continent. The challenges are multifaceted. Banks are being put under a new kind of scrutiny. Regulators are now testing their resilience not just to market crashes, but to political shocks.